Okay, let's begin our today's session. Is there any background disturbance from my side? Is it all
No,
fine?
no, this is
Okay,
fine.
okay.
This is fine.
Okay, a very good morning. Sorry for the inconvenience.
No problem.
Uh, okay,
No
okay.
problem.
Let's begin our today's session. This is session number 2. Yesterday we started learn about IFRS, and we started our IAS 16 as well. Okay, therein we understood the definition part. Okay, what are the items that are included when the intention is to be used for the business purpose? We said that, okay, let's classify it as property, plant, and equipment. Okay, and then we understood that it should be a long term asset. It can be for the administration purpose also. Okay, therein we also understood that it can be either recorded at cost or at fair value, or you can say reval model. If it is being recorded at cost, then there were number of costs that should be included, and there was list of costs that should not be included. They should not be capitalized. Instead it should be charged to PL. We have understood that. Okay. Also, yesterday we discussed that how to account in case of initial recognition. Okay. Therein I'll quickly try to recap the same. I'll quickly try to recap the same. Okay, we said that if it's a revaluation model, okay, if there is upward valuation, that means in case if the amount is higher as compared to your book value, then you have to book the difference. Okay, in that case, we said that, okay, the gain will be recorded, okay, but will be shown under other comprehensive income. This means the journal entry that will be passed will be asset amount will be increased, and simultaneously a credit will be put to your statement of PL and OCI account, but the amount of gain will be shown under other comprehensive income. Okay. On the other hand, if it's a loss, if it's a downward valuation, then we said the difference amount will be taken to statement of PL and OCI, but this loss, this due to downward valuation, due to fair valuation, will be taken towards PL. Please confirm, is it clear?
It is clear.
It is clear. Okay. Okay. If you're clear with this, then we can go ahead with subsequent recognition, subsequent recording. So this is initial recording. Initial recording means the recording that you're doing, the accounting that you're doing on the first day itself. Okay, on the time at the time when it is being introduced in the business. Okay, when it is being recorded for the first time in the books of account. Okay. On the other hand, subsequently means how to deal with it on each reporting date. What is reporting date?
31st March or 31st December.
Okay, the day when you are preparing your financial statement. It is generally 31st December or 31st March. Okay, so the reporting date, on that reporting date, how do you deal with this? Okay, ahead. So this is known as subsequent accounting under reval model. This is under revaluation model. Under a reval model. Okay, herein we'll classify it again later. Okay, now, okay, again, when on each reporting date, when you're doing your subsequent recognition, okay, therein, again, either there will be upward revaluation or there will be downward revaluation. Okay, either there will be again upward valuation or there will be downward valuation. Okay, Either there will be upward valuation or downward valuation. Okay, let's understand this. For example, 31st March 2020, 31st March 2021, and then 31st March 2022. Okay, we'll try to take the yesterday's case itself. Okay, so in case number 1, when there is upward valuation, your PPE was shown at 1 lakh rupees initially. Later on the subsequent date, next reporting date, for example, it was 120. Okay, in yesterday's example, we said that, okay, for example, case number 1, your PPE was 1 lakh, but later in the next reporting date, it was 1,20,000. Now, this is known as subsequent reporting date. Next to next, what will happen? Okay, so we said that first time, if there was 20,000 increase, where did we charge? PL or OCI? Where did we charge?
Increase
Yes,
OCI.
OCI. Okay, this part was shown under OCI. Okay, this part was shown under OCI. Now, in case if we say that, okay, in case again if there is an upward valuation, then what do you do? How do you deal with this? It says that firstly, okay, firstly, okay, reverse, okay, any loss on fair valuation or revaluation. Firstly, reverse any loss on fair valuation charged to PL, okay, in previous years. Okay, and then secondly, okay, if surplus, or you can say if still reval surplus is remaining, then it will be charged to OCI. Then it will be charged to OCI. Okay, just a case. For example, earlier, if there was a loss of $100, okay, then what do? You simply reverse that off, and then the remaining balance will be charged to OCI. Okay. On the other hand, in our example, for example, there was a gain of 20,000, which was recorded under OCI. Okay. For example, in the current situation, again, if there is a gain, you will again charge that to OCI. Got it? For example, if it's again 130. Okay. So 20,000 was charged under OCI. Remaining 10,000 will also be charged to OCI. Got it? But in case if it's a separate case, okay? Good, Hanishakar. Case 2. For example, it was 1 lakh in the beginning. For example, now it is $95,000. Okay. So the difference was charged to
P&L.
PL. Okay, difference was charged to PL. Now, for example, again here the amount is 130. Again here, for example, the amount is 130. Okay, these are separate examples. Okay, what to do? It says that firstly reverse previous year's PL. Okay, this means you'll be crediting your PL. Earlier you have debited your PL with a loss of 5,000. It says that increase, or you can say reverse PL. Increase PL first by $5,000. Okay, remaining 30, there's a $35,000. Remaining 30,000, okay, remaining 30,000 balance will be charged to OCI. Okay, I'll give you more examples. But right now it says that do not charge to OCI directly. Instead, if there is any previous year amount that was previously in previous year, it was charged as a loss in the PL, then please reverse that off first. The remaining balance will be charged to OCI. Okay, this means the journal entry will be, okay, in this case, the journal entry will be, earlier it was PPE, earlier, for example, it was loss on reval of PPE. For example, it was $5,000. Okay, to PPE, $5,000. In second year, what will happen? In second year, what will happen? What will be the journal entry?
First we have to reverse the loss. So which means,
Perfect. Okay. Yes.
so we will debit PPE, credit loss on reval 5,000.
Perfect. Okay. This means we will increase our PPE by 35,000. Okay.
So
We'll
5,000
increase our
loss on reval, 5,000 for
perfect.
OCE.
Perfect. Okay. This will be to gain on reval. Okay. And to reval surplus. Okay. Good. Very good. This will be $5,000 and this will be remaining $30,000. Very important. This will be shown in your PL as a reversal of the previous year's loss, and reval surplus will be shown under OCI. Is it clear? Good, good. Okay, good. If you talk about our, we'll also take another example. Let's come back to our valuation. In case if there is a downward valuation, what do? Firstly, reverse, firstly, reverse any reval surplus, okay, charged to OCI in previous years. Firstly, we will reverse that. Okay. Secondly, in case if there is still excess loss, if still there is any excess loss, balance remaining, okay, then it will be charged to PL. Then charge to PL. Okay, very important. Sometimes students conclude that okay, reval surplus will always be charged to OCI, and if there is any loss on reval, it will always be charged to PL. Okay, this is not the final conclusion. Sometimes students get confused that okay, in their questions, in their balance sheet, if they see, I would say, profit on revaluation, if they see a posting in the PL part, it says that okay, it should always be charged to OCI. Why it is being credited to PL? Okay, please understand this happens because of the subsequent revaluation model. It says that if there was earlier something charged which was in the opposite direction, let's reverse that off, and then if there is any remaining balance, then write it in the OCI if it's a profit, write it in the PL if it's a loss. Any doubt?
No.
Okay, good. Have you noted? Do you want me to wait?
No, yeah, noted.
Good, good. Okay. Let's take an example. I want you to pass a journal entry. In first year, there was an upward valuation of $600. In subsequent year, there was a downward valuation in the PPE by $950. Okay. I want you to pass a journal entry for both the years, for first year as well as for the subsequent year.
First year it is PPE debit to OCI $600.
Good. Okay. So there is an upward valuation. Your
Yeah,
asset will get increased by the difference amount and it will be charged to
revaluation surplus.
reval surplus. Okay. Under
OCI.
OCI. Good. Very good. Okay. Under OCI. And this is your balance sheet item. Okay. What will happen in the next year?
OCI debit 600, P&L 350, PPE 950. Credit PPE 950.
OCI debit.
Uh,
Okay.
you have to reverse that 600 first.
Okay. Good. Good. This means your PPE will be credited
950.
by $950. Okay. To record this $950 loss, do not right jump into the PL. Very good. Firstly, reverse.
Reverse OCI.
Very good. Revaluation surplus, if any. Okay. If any, that is, we already have $600. Okay, in the reval surplus of the earlier year. Okay, then the remaining balance. Good. Then the remaining balance loss on fair valuation. Okay, of PPE will be debited, and this will be debited by only the difference amount, that is balancing figure. Okay, very good. Okay, so this is your OCI item. This is your PL item. Just take a look so that you're not getting confused when it comes as a part of your bigger question, bigger case study. Okay. So loss on reval can be shown under OCI. Despite we have loss, still in the case of loss, your OCI can be hit in case of PPE. Okay. Just because we are doing in subsequent reporting, we are required to reverse something that was already done in a opposite direction. Is it good? Is it fine? Is it clear? Good, good. Okay, I'll quickly tell you how it impacts your statement of PL and OCI. Okay, how its impact is taken. So your statement of PL and OCI, that is PL and other comprehensive income. So as we know, it has a PL part as well as it has OCI part. Okay, in the year one, what will happen? In year one, okay, there will be a revaluation surplus. There will be a gain on revaluation, or you can say there will be a revaluation surplus, okay, of $600. In year two, what will happen? In year two, firstly, we will cancel this reval surplus, okay? Firstly, we will cancel this reval surplus, okay, by $600. The remaining balance out of 950 will be charged to PL, okay, loss on reval, okay, will be charged to PL. Okay, and it will be a negative figure. And how we have calculated, our entire loss was of $950, but 600 have been adjusted from the OCI. This is how our PL will be impacted in if we talk about our both the years. Okay, this is year 2 in year. Any doubt? Is it picture clear? Good, good. Okay, so again coming back, under revaluation model, we say that whenever you are, and this will be applied for next like 10, 20, 30 years till the useful life is there, till the PP is there in your books of account. Okay, until it is de-recognized. Every year is a subsequent year. You have to check what is the up-to-date reval surplus. If any, then please make sure that in case if today also in the date, if there is an upward valuation, you'll add your revaluation surplus. You'll increase your reval surplus. In case if it's a downward valuation, then please decrease it from the OCI first. And then if it's an excess loss, excess downward valuation, then please charge to PL. Okay, good. Okay, now how to deal with depreciation on revalued asset. Okay, it depends upon when the revaluation has been done. Okay, it depends upon when the revaluation has been done. Is it at the start of the year? Please let me know in case I need to wait for a while so that you note it down. Okay, please make simultaneous notes. So is it done at the start of the year, or if it's done at the mid of year, or is the revaluation being done at the end of the year? Okay, it depends whether the revaluation has been done at the starting of the year, is it done at the mid of the year, or is it done at the end of the year? Okay, now why will it be done for the start of the year? Why will the revaluation will take place mid of the year? Okay, see, there are cases when we go ahead with the consolidation, we'll see that the consolidation, or you can say their mergers, acquisition, can take place at any date. For example, on 1st May, the acquisition has taken place, so it's a mid-year. Okay, for this purpose, the asset have been fair valued. Got it? So there are many cases, there are many circumstances wherein mid-year revaluation is required, mid-year fair valuation is required. For the year end, you always know if you are following revaluation model, you have to get it done at the each reporting date. So I think for the year end, you must be very clear. But it might happen at the start of the year. There might be circumstances when you are doing revaluation, when you are required to do fair valuation in the middle of the year. Okay, how do you go ahead with the depreciation? How do you go ahead with the depreciation? Okay, so it says that if the revaluation has been done at the beginning of the year, what do? You simply revalue asset first and then charge depreciation on revalued asset, revalued on revalued amount. Okay, just an example. For example, your carrying amount, okay, your book value is of $100. But for example, there is a revaluation, okay, revaluation done, and it is of $120. Got it? Now the question arises whether to charge depreciation on $100 or $120. Give me a quick thumbs up. Do you understand the case? That, for example, your book value, the carrying amount of the asset is $100. But for example, there is a revaluation done. And because of the revaluation, it's $120. Okay. Now, the question arises whether to charge depreciation on $100 or whether you should charge depreciation on revalued amount, that is $120. So it is said that if the revaluation has been carried on at the beginning of the year, okay, then as we know, we always charge depreciation on the opening figures. Okay, we try to okay, so on this basis, you are required to charge depreciation on 100 or 120.
120.
120. Okay, you are required to charge depreciation on 120. Okay, coming back to next pointer, if it's a okay, for example, if it's a mid-year revaluation, then you have to use pro rata. You have to use pro rata on time basis. Okay, you have to use pro rata approach. This means you have to bifurcate. For example, it was taken on 1st May. The mid-year was, for example, 1st May. Okay, so and we are taking our financial year from Jan to December. So 4 months and remaining 8 months. Please understand. For 4 months, the depreciation will be charged on the book value. For the remaining 8 months from the time wherein the revaluation was done, the depreciation will be charged on the revalued amount. Okay, just an example. Okay, you will charge depreciation, okay, on $100 for 4 months, and you will charge depreciation on $120 for 8 months. Is it clear? Good, very good, very good. Okay, we say that if it's a mid-year revaluation, okay, this means you have to bifurcate and time a portion on the basis of duration, on the basis of time duration. Okay, and till the point of time the revaluation was not done, please charge depreciation on the carrying amount on the book value. Whereas right after the revaluation was done, please charge depreciation on the revalued amount. Now coming to our next case, that is end of the year. So if the revaluation is taking place at the end of the year, it says that charge depreciation first, charge depreciation first, and then revalue. Okay, charge depreciation first, you could say on carrying amount, and then revalue. Okay, this means here, firstly you will charge depreciation on $100 itself, that is book value. Okay, that is your book value, and then you will compare it with then revalue. For example, then revalue and fair value are one and the same thing. Then revalue, that is at $120, and whatever the difference will be, okay, after depreciation, for example, it's a 10% depreciation. So $100 minus 10%, that is $90. So depreciation will be charged on $100. Whatever the carrying amount comes up, that is, for example, $90. Okay, then you will revalue. Let me clear this one more. Let me make it more clear. Firstly, you will charge depreciation on $100, that is, for example, at the rate 10%. So you'll decrease your depreciation first. That is, your carrying amount will be $90 now. and then you will revalue, and the revalue will be, for example, of $120. Okay, this difference will be then charged to OCI. Is it clear? Good, good. Any confusion, any doubt?
No.
Good, good.
Yeah.
Okay, so let's try an example. Auckland company purchased a machine for 60,000. Okay, on January 2007, and determined that it had a useful life of 15 years with nil residual value. On 31st March 2009, it was revalued to 64,000 with no change in useful life. Useful life is same right now. Okay, so from 2007, okay, it is 2009 now. Okay, with no change in useful life. What will be the depreciation charge in relation to this machine in the financial statements of Auckland Company for the year ended 31st December 2009? Okay, so firstly, let's draw a timeline. What is your financial year? Financial year?
Year Jan to
Yes,
December.
Jan to December. Okay, so your financial year is from Jan to December. I would say keep a practice. Make sure that whenever you're going ahead with any question, any example, make sure you identify your financial year correctly. Okay, foremost, so that whenever we are doing calculations, we know when to and what to include and what not to include. Okay, so if we start from our Jan, 1st Jan 2007. Okay, then 31st December, then it will be 1st Jan 2008. Okay, then there will be 1st Jan 2009, and then there will be, for example, 1st Jan 2000. Okay, there is a mid-year revaluation at what amount? Okay, what is the date? 31st March 2009. Okay, and the total useful life is 15 years. Since it's a mid-year acquisition, since it's a mid-year revaluation, I would recommend you to calculate months. Okay, calculate your depreciation in months. So 15 years life into months. How many months? 12 months. So total useful life is 15 into 12.
180 months.
180 months is your useful life. Okay. So this is your 2 years and 3 months, whereas this remaining is the remaining life. Okay, that is how much? Calculate. Try to calculate.
I didn't get you.
Very good. Okay, so that is 2 years and 3 months. Okay, or you can say how many months? 24 plus 3, that is 27 months. So before revaluation, we have to charge depreciation for 27 months. After revaluation, how many months? If I talk about the useful life,
153 months, I think, roughly.
153 months. How have you calculated? 180 minus 27. So this is your 153 months. Is it clear? Total remaining useful life. Okay. And if I talk about this financial year, so this is 3 months and this is 9 months. Is it clear? So total remaining useful life is 153. Very important. Whenever you are charging depreciation, okay, on the revalued amount, you have to charge only for remaining useful life. Remaining useful life. For remaining useful life. So 8 months will be charged for this financial year, but the denominator will not be the whole useful life. Instead, it will be only the remaining useful life. Is it clear now? With the help of an example, I'll also tell you. Right now, we have to recognize what will be the depreciation during 1st Jan to 31st December in 2009. What will be the depreciation amount that should be recognized in 2009? Okay, in the financial statement. What should be the depreciation chart to be to the PL? Is it clear? Is the question clear? Okay, try to calculate, then I'll tell you how to approach the same. What is your depreciation amount?
For 27 months, is it $9,000?
Good, good. And okay, also you have calculated for entire 27 months, but right now the question is asking only for 2009 period. That means we have to calculate for this 3 months and we have to calculate for this 9 months only. This 3 months will be calculated on 60,000, whereas this 9 month amount will be calculated on 64,000. Here the useful life is 180 years, whereas after evaluation the useful life is 180 months. The after evaluation the useful life is 153 months. Try to figure out, try to calculate, then I'll help you. Instead of calculating for entire 27 months, calculate only for 3 months plus 9 months. 3 months,
Is
oh
it
yes, yes,
$4,765?
4765. Yes, the answer is correct. Okay. How will you approach the same? $60,000 into 3 months divided by 180 months plus 64,000 into 9 months divided by 153 months. Okay. So what is your amount? Separate amounts.
1,03765.
Perfect. $1,000 plus $3,765. Okay, that is $4,765. Okay, good, very good. So we said that in case if it's a mid-year revaluation, if during the year there has been revaluation done for any reason, then in that case, what do? For the part till the portion the revaluation was not taken place, you will charge depreciation on the book value itself, on the carrying amount itself. As soon as the revaluation is done, for the further part you will be recognizing, you will be calculating depreciation, okay, on the remaining part, but on the revalued amount on the basis of remaining useful life. Is it clear?
But how
Very
will we do
important.
it?
Yes.
How will we do in WDV method? We have to arrive at the value before Jan first and then continue, no?
Yes, then continue. Yes. Okay, you have to firstly arrive at 1st Jan 2009 figure. Okay, and then charge depreciation for 3 months. Okay, then you will go ahead with the revalued amount. Okay,
Okay.
in that case, what will happen? Then this approach will be done. Okay, depreciation will be calculated on the initial carrying amount. Okay, on the WDV on 1st Jan 2009. Okay, for 3 months. Then when you reach to a amount, okay, this is your carrying amount. Then the revaluation will be done. Whatever the difference will be charged to your OCI. Then ahead you will be recognizing your WDV as 120. Okay, henceforth, for example, from the March, and then you will charge depreciation on 120. Is it clear?
Okay. Okay.
Got it? Okay, then your WDV for the revalued period, for the period after revaluation, will be your 120. Okay, and then you'll be charging depreciation on revalued amount for the remaining months using the remaining useful life. Okay, next. Before we go ahead with compound asset, okay, let's discuss compound asset, then I'll tell you about the revaluation. Okay, what are compound asset? Compound asset which has more than one asset, okay, or you can say group of asset which has different which has different useful life, or you can say different rate of depreciation. Different rate of depreciation. Either the useful life is separate or the rate of depreciation is separate. Okay. Example, very simple example, land and building. Okay, as we know, land always have 0% debt, whereas building might have 5%, 10%, 20%. Okay, for example, 10% debt. Got it? But as you can see in your balance sheet, you will also always see a line item that is land and building, and the together amount will be shown. Okay, for example, it is of 10 lakh, and for example, the building is of 20 lakh. So in your balance sheet, your land and building will be shown at 30 lakh. Agreed? This is known as compound asset. Group of asset, more than one asset, but they have different useful life or different rate of depreciation. How to deal with the same? It says that simply calculate depreciation, separately. calculate your depreciation separately. This means under this case, land will be hit with zero depreciation, no depreciation. Whereas with the building amount, that is 20 lakh into 10%, that is 2 lakh amount. So your depreciation will be 2 lakh. Is it clear? You will record your depreciation deduction of 2 lakh and you'll net it off from the amount, and your land and building now in your balance sheet will be shown at 28 lakh. Is it clear? Okay, compound asset, this means more than one asset. If its useful life is different or if the rate of depreciation is different, then please calculate depreciation separately. Okay, one more example I'll give you about different useful life. See, as we know, if there are huge expenses done, even after the asset is put to use, okay, is ready for use, that will be capitalized. For example, there is a huge repair and maintenance done, which increases the capacity. The engine has been changed. Okay, anything like a huge repair and expense has been done, then the company can go ahead with capitalization. This means it will be added. A very good example about the same is, okay, example, ship, okay, and overhaul. This is very common example. Overhaul expenses. These are huge expenses. Okay. For example, it is of ship is of 20 lakh, whereas overhaul are major repair and expenses, okay, to and which are very compulsory, cannot be avoided. This is for example of 6 lakh rupees. Okay, for example, useful life, if I talk about cost, if I talk about useful life, this overhaul expenses are required to be done each 5 years. After every 5 years, you are required to do this overall expenses. So we can say that the useful life is here, for example, 20 years. But here it is of 5 years or 6 years. Okay, for example, just to make it simplify, I'm taking it here 6 years. Okay, herein it is recorded as one item in the balance sheet. Okay, in your balance sheet, you can say there will be ship expense of 26, there will be a ship asset that is of 26 lakh. Okay, this overall expenses are capitalized. These are capitalized. Any doubt till here? This is an example
No,
of compound asset, complex asset. Yes,
no doubt, no doubt.
no doubt, no doubt. Okay. So how do you charge depreciation? Again, it says that calculate depreciation separately. So depreciation will be calculated separately. Okay. Calculation of depreciation will be separately. 20 lakh into divided by 20 years, that is 1 lakh, plus 6 lakh divided by 6 years, that is again 1 lakh. Okay, so your depreciation will be 2 lakhs. So from your ship, you have to deduct depreciation of 2 lakh again, and your ship after accumulated depreciation deduction will be shown at 24 lakhs. Please understand, we are showing asset as single line item. We are showing the asset as single line item, and in case if it has multiple items in it, and if it has if it attracts different rate, different useful life, then please calculate depreciation separately on each component. Okay, please calculate depreciation separately on each component and then deduct it and show it, okay, in your statement of financial position, or you can say balance sheet. Is it clear till here? Make sense? Okay, okay. Okay, this is an example. I want you to try this example. Okay. Um, let's take a break first and then we'll try this example. Is it fine?
Okay.
Okay. Do you want a break or we can continue?
Three, 3 minutes break.
Okay, okay. Let's have 5 minute break. We'll connect back at 8:05.
Okay.
Okay, good. Okay, let's continue our session. We were discussing about compound asset. Let's try an example.
Yeah.
Okay. Weatherby Company purchased a machine on 1st July 2007 for $500,000. It is being depreciated on a SLM basis over its useful life of 10 years. Residual value is estimated at $20,000. Okay. On 1st January 2008, that means after 6 months from 1st July, if you calculate, 1st January 2008 is your 6 months. Following a change in legislation, that means there has been a change in law, because of which Weatherby Company had to fit a safety guard to the machine. The safety guard costed $25,000 and has a useful life of 5 years with no residual value. So we have $500,000 machine which is having a useful life of 10 years. Because of change in law, there has been a new asset that has been introduced and added to the machine. So this has been capitalized. Okay, it has been capitalized. Has been capitalized. Useful life of machine of safeguard is 5 years, but of the machine is 10 years. Okay, so this is a clear case of compound asset which has different useful life. Compound asset, okay, with different useful life. Okay, so our component 1 is your machine, whereas our component 2 is our safety guard. Okay, so what is the depreciation for machine? We are only required to calculate the debt part. What amount will be charged to PL? Okay, only the depreciation part is required to be calculated. So depreciation for machine will be $500,000 minus scrap value. What is your scrap value? That is $20,000. Okay, divided by, either you can convert this 10 years into months. Okay, that is 120 months, or you can simply divide 10 years and 6 months divided by 12 months. Okay, so either divide by 10 years separately and then proportionate for the month period. Otherwise, what you can do, your financial year is from, see, I've done a mistake. Your financial year is from April to March. Your financial year is from April to March. Okay, this means from 1st July 2007 to 31st March 2008. This is not 6 months. Instead, it is 9 months. Is it clear? The financial year is from April to March. This means if you calculate months from 1st July 2007 to 31st March 2008, then it is only 9 months, not 6 months. Plus, you have to record depreciation for safety guard. It will be calculated separately. That is $25,000. There is no residual value given for the safety guard, so nothing will be deducted. Divided by how many years? 5 years. And what is the period during which it has been used? That is from 1st Jan to 31st March. That is only 3 months divided by 12 months. Either you can calculate the entire period in months, or you can divide by years and then proportionate it only for that duration of time. Is it clear? Okay, this is from July to March, and this is from Jan to March. Please confirm, is there any doubt? Are you able to solve along with? Yes, yes.
Okay, got it.
Got it. Okay, so what is the amount?
It, total it is 39,750.
39,750. Calculate again.
36,000 for the asset.
36,000 for asset. Okay.
Just a second.
And
3 by 12.
3 by 12.
1,250.
1,250. 1,250. Okay. That is 37,250. Okay. This means in your balance sheet, when you show, your asset will be shown as machine, and machine will be of 5,25,000. Okay, because it has been capitalized with safety card, and you will deduct a depreciation of 37,250. Okay, so 525 minus 37,250, that is 487,750 will be shown as your net asset. Okay, in balance sheet. Is it clear? This will be your carrying amount, book value. Any doubt?
No.
Good, good. Have you noted this example?
Yeah.
Good, good. Okay. Okay. Next, there is bearer plant. Bearer plant is also considered as property, plant, and equipment. Bearer plants are biological asset. Okay, are living plants and animals, but still they are not covered under separate standard for agriculture and biological asset. Instead, bearer plants are considered as property, plant, and equipment, and we are required to apply IAS 16. What are bearer plants? They are living plants and animals, and they are living plants. Okay, but they do not have capacity to be sold on their own. Instead, they help in further production. Please understand. They have remote likelihood of being sold as agriculture produce. They cannot be sold therein. Instead, their produce is sold. For example, grapevine. Grapes are sold. Okay, the grapevine is not sold. Grapevine instead helps in further production of grapes. Got it? So bearer plants, since they are being used for further production, therefore they are being classified as PPE instead of biological asset, despite being living plant. Okay, noted. Any doubt? Any question?
No.
Okay. Okay. As we are following BPP kit, okay, that is BPP publication. There is Kaplan and BPP. There are only two publications by ACCA. Okay, so we are following BPP. So BPP has a very good example related to revaluation. We will quickly look at the same. Now, before going ahead with the example, I just want to clarify. Is it clear? Is it visible enough?
No, the previous size was very visible.
Previous size wasn't.
Uh,
Okay, okay. Okay, before going ahead with the understanding of the same, let's understand one thing, that in your balance sheet, which is known as statement of financial position, we have equity. Please understand, equity is a very broad term which contains share capital. Okay, it can be preference share capital, it can be equity share capital. Okay, then it contains, for example, share premium. Okay, then it contains, for example, retained earnings. Okay, earlier we used to call it as reserves and surplus. Okay, it has revaluation surplus. Okay, that is because of the gain that you have done, that you have realized, that you have accounted, okay, on the fair valuation of any certain asset, because the standard was same. So equity is a very broad term which contains equity share capital, preference share capital, retained earnings, reval surplus, etc. Okay. Now, for example, if any revaluation is done, any gain on revaluation is there, okay, we have recorded it as revaluation surplus and charged under OCI. Okay, and we will show it under equity. Please understand. Now, for example, the revaluation has been done. Okay, now this revaluation has, for example, a balance of 10,000. Now it says that it is company's choice. Okay, either to charge excess depreciation in the OCI itself, okay, through reserve and surplus, or transfer reserves and surplus to retained earnings when the PPE that was revalued will be de-recognized. There are two ways: either charge over the useful life, or charge in one go at the de-recognition time. There are two ways: either record and transfer to retained earnings, okay, on the de-recognition, or or transfer to retained earnings throughout the life. Okay, let's take an example. Crinkle company bought an asset of $10,000. It had a useful life of 5 years. On 1st January, the asset was revalued for 12,000. That means 3 years later. Okay, January to entire 2006, 2007, 2 years later. Sorry, 2 years later. Sorry. Okay, 2 years later, the asset was revalued. The expected useful life has remained unchanged. Account for the revaluation under 2008. Okay, so if you talk about 1st Jan 2006, our asset is of $10,000. Okay, then you'll be charging depreciation for 2006. Okay, remaining useful life is 5 years. Okay, so depreciation will be $10,000. There is no residual value divided by 5 years. Okay, that means your depreciation is $2,000. Okay, depreciation for year 2007 will be again $2,000 because we are following SLM basis. This means carrying amount on 1st Jan 2008 will be $6,000. Is it clear? We said that there was an asset of $10,000. 2 years later, it has been revalued. Okay, now the revalued asset is revalued on 1st Jan 2008 for $12,000. The carrying amount is $6,000. It has been revalued for $12,000. Okay, what is your gain? okay, which is known as revaluation surplus. Your revaluation surplus will be of 6,000. Okay, and this will be shown in your OCI. This will be shown in your OCI, okay, as revaluation surplus. Is it clear? Any doubt in here? Look at the question again. It says that an asset was bought on for $10,000 on 1st Jan 2006. 2 years later, there have been revaluation. They are following depreciation on the SLM basis, and the useful life is given 5 years. The scrap value is 0. Is it fine till here? Anybody, any doubt? Any doubt? Is it good? Okay. Now, let's talk about excess depreciation. Excess depreciation. Okay. Earlier you were charging 2,000 per annum as your depreciation. Okay. This was before revaluation. Okay. Now please tell me what will be your depreciation after revaluation. What will be your depreciation? Is there any change in useful life? The remaining useful life has been unchanged. Please tell me what will be the revaluation? What will be the depreciation after revaluation?
$4,000.
4,000. That is $12,000 into remaining useful life. That is 1/3 years. Okay, good. Your depreciation after revaluation will be 12,000 divided by 3 years. That is 4,000 per annum. Got it? Now we can see that due to revaluation there is excess depreciation. Due to revaluation there is excess depreciation. Excess depreciation of how much? $2,000 per annum. Do you agree with this? Give me a quick thumbs up. Before reval, we were charging 2,000 depreciation per annum, and after depreciation, we are charging 4,000 per annum. So there is a 2,000 more depreciation, excess depreciation due to revaluation. Now it says that either, and this is because if you can determine this, this is because this normal 2,000 is for PM, whereas the remaining is for OCI. Got it? So we say that excess depreciation either should be charged to OCI each year, or secondly, the second circumstance is transfer entire revaluation surplus in one go to the retained earnings. Okay, either transfer this revaluation surplus to retained earning over 3 years period, or charge it in one go. It is choice of the company how it want to go ahead. So see, on 1st January 2008, please read the definition. Please read the journal entry. The depreciation till date will be debited. The asset that has been valued will be debited, and there will be a revalue surplus of 6,000. Okay. Excess depreciation. How do you charge excess depreciation? revaluation surplus is being charged to retained earnings by excess depreciation. Any doubt? Either you can charge revaluation surplus towards retained earnings in one go on the derecognition, or you can charge it over the useful life, that is over the 3 years, in the form of excess depreciation with the amount of excess depreciation. Can you relate this example? Are you able to conclude this example? Is there any doubt?
No doubt.
No doubt. Okay, it is simply said that this entire 4,000 depreciation should not hit PL. Instead, it should I would say it should hit PL only till the amount of 2,000, and the remaining excess depreciation should hit OCI, or you can say equity. Okay, it should hit OCI, or you can say equity. Okay. We'll quickly take another example from your revision kit that tells about a question is given. I'll try to share the same. Okay, have you tried yesterday's example wherein there was SLM, WDV, and number of days were given, and there were 3 methods via which you can calculate depreciation? Have you tried that? Have you seen that?
I saw that.
Okay, was there any difficulty?
No.
Okay, so there is the same question in your ACCA workbook also, wherein which tells that okay, there are different methods how to calculate SLM, WDV. So I don't think it's there is any need to again calculate the same. Okay, if there is any difficulty, do ask. So we can go ahead with another standard, that is IAS 40, investment property. We said that here the intention matters. Okay, the way you are using the asset. If it is only to collect rentals or difference in the capital, okay, that you have invested, and the amount that you are getting on the receipt, that is capital appreciation. For example, you have bought a land of 20 lakhs and then you are selling it 5 years later at 25 lakhs. Then this 5 lakh is known as increase amount of 5 lakh is known as capital appreciation. So either your intention is only to collect rentals or to get amount and benefit of capital appreciation, or both, then this is known as investment property. It should be recorded as separate line item in the final statement of financial position. Okay. See, the rental should not be your business purpose. Your core business should not be of rental. Okay. Your intention is to collect rentals. Okay. You have bought this asset, you have invested this asset. Okay. Considering that, okay, let's collect rentals on the same. If it is not used for business purpose, then we'll classify the asset as investment property. Owner occupied property, we'll quickly check its intention first. Okay, what is the intention behind the use? What is owner occupied property? For example, the owner, instead of introducing capital, they have said that, okay, let's use my extra building for administration purpose. Let's use my building. Okay, I am the owner of this building. Let's use this building for for office purpose. For example, I have a barren land. I would say vacant land. Let's build a factory on the same. So if there is any owner occupied property, how do you classify the same? You have to check its intention. If that owner occupied property is being used for business purpose, then you will classify it as property, plant and equipment. If that owner occupied property is being used for investment purpose, for collecting rentals and capital appreciation, then you go ahead and classify it as investment property. Whenever you are classifying something as investment property, we have to apply IAS 40, or you can say Ind AS 40. Is it clear? Any doubt?
No doubt.
No doubt. Okay. So we have to check what is the purpose, what is the intention behind the use of that asset. Sometimes the question states that, okay, the asset is being used for administration purpose. Do you classify it as PP or investment property?
Administrative, it is PPE.
Very good. Very good. Okay. In case if I say it's an owner occupied property used for production.
PPE.
PPE. Okay, good, good. Okay, we say that if it is being used for business purpose, administration purpose, head office purpose, etc., then we classify it as PPE. If your intention is just to collect rents and capital appreciation, we'll go ahead and classify it as investment property. Okay, noted also. Can I go ahead?
But this would change for real estate company, na, which is into the business of.
Yes, yes. As soon as it becomes your core business, then you have to classify that real estate properties as your PPE.
Okay.
Okay, because you're not waiting for capital appreciation. Instead, your intention is to sell it and then get your sale consideration, get the profit
Or
in
rental.
change in price. Yes, or rent it. Okay, so if for example, if you're a broker or if you're the owner of like hundreds of flats, okay, if your core business is of real estate, if your core business is of renting and letting out, then in that case, it will be considered as your PP.
Okay.
Okay. Therefore, I've said check the intention of use. Have you noted also?
Yeah, I've noted.
Okay, good. Okay, and what is the recognition criteria for the investment property? When do you record in the books of account? It is very similar to PPE. That is, as soon as you're very highly probable that okay, there will be economic benefit that will flow to you, and the entity will be entitled for the same, you can recognize the asset. Also, if the cost can be reliably measured, both recognition criteria are exactly the same as PPE. Okay. Give me a thumbs up if I can go ahead. Okay. If you want me to wait, then I'll wait for noting down.
We can proceed.
Okay, good. Okay, now how do you recognize? It says that on initial recognition, you always have to record it at cost. On initial recognition, you always have to record it at cost. But if we talk about subsequent recording, it's a choice with the entity. Entity can choose to record it at cost again, continue to record it at historical cost again, or they can use and they can apply fair value model. Okay, they can apply revaluation model. Revaluation and fair valuations are one and the same thing. So it's a choice given to the company for the subsequent accounting, whether they want to go ahead with cost model or they want to go ahead with fair value model. Okay, noted down this, then I'll tell you how it differs from cost model to fair value model.
Noted.
Noted. Okay. If I talk about cost model, then you have to charge depreciation. Charge depreciation. Okay, charge depreciation. Okay, and we have to check for impairment. Check for impairment loss. What is impairment? We'll read ahead in next 1 or 2 classes. Okay, but right now just understand, if there is any investment property which is being recorded subsequently at cost model itself, then we have to charge depreciation and we have to check for impairment loss, if any, and record the same. In case if we are following fair value model, we are not required to charge depreciation. Do not charge depreciation. Do not charge depreciation. This is super important. And secondly, if there is any gain or loss on valuation, gain or loss on fair valuation, okay, is always charged to PL. Okay, these both the things are super important. In case when we are recording investment property on fair value model, we are not required to charge depreciation. And secondly, if there is any difference in amount and if it results into any gain or loss on revaluation, on fair valuation, then it will always be charged to PL. It is very different from PP. In PP, we said that if it's a gain, let's charge to OCI. If it's a loss, then charge to PL. Wherein for investment property, you always have to charge any sort of gain and losses to PL directly. Is it clear?
In fair value model, do not charge depreciation means for the excess portion or the entire asset?
For the entire asset. For the entire asset, you stop charging depreciation. And why so? Yes.
Building would be depreciable asset, na, in any case.
Definitely. But if you are okay, building, if you are using it for the collecting rental purpose, okay, then you are recording it as investment property. For that building, if you are recording at fair value model, then you will not charge depreciation. And guess why?
Because the fair value will always be loss.
Either you can say that. Also, fair value itself represents, okay, always represents the current value. It already, I would say, takes into consideration all the wear and tear or any upgrades that are being made. Just an example, for example, a mobile phone. Okay, just an example. Okay, a mobile phone, if you purchase it right now, for example, it is of 30,000 rupees. As soon as you crack its seal and open it up, okay, and you feel like, no, this is not my type, I'm not getting a vibe. One day later, you feel like, okay, let's sell this mobile phone. It's just, it has not been used yet. Only you have cracked the seal and if you have just unboxed the same. Got it? Will you be able to resell it at 30,000? No. Okay, no. Instead, somebody will be ready to give you 27,000 exact. Okay, one day later. Example, if you have used it for 1 year, okay, you will be able to sell it, okay, for example, at 20,000. 2 years later, it will be sold only for 15,000. Got it? This is your fair value. Fair value already includes all the changes that have happened to the asset. If it's a good one, it will include that. For example, talking about land, because there was a new highway constructed, the land figures, okay, have increased by 10x. The amount of land, the property value around that highway has gone up by, for example, 10 times. On the other hand, if you talk about any building, for example, it has become old by 3 years, then the fair value will take care of these, I would say, changes that has happened to the building. Therefore, if you are already considered fair value, since fair value already includes all the changes that has happened to the asset, therefore, it is said that do not charge depreciation after recording the investment property at fair value. Okay, does it make sense? Are you able to connect?
Yeah.
Okay. So it is super important, and it is highly, I would say, confusing, as well as the questions are asked in a way wherein you have to be very, very alert whether you are required to charge depreciation or not, whether you are required to charge your gains to your PL or to your OCI. Be very vigilant, be very alert about the same. So for example, if you have any investment property and if you are following fair value model, then please, please, please do not charge depreciation and charge all the gain losses that has happened due to fair valuation to your PL directly. Okay. So IAS 16 says that if it's a gain, charge to OCI. If it's a loss, charge to PL. But on the other hand, if we talk about IAS 40, it says whether it's a gain or a loss, always charge to PL. Is it clear? Please confirm. Is it clear? Any doubt?
Yeah, clear.
Clear? Good. Okay. So if you are clear with this, it applies to both. We'll take another topic, that is deferred consideration. What is deferred consideration? This is simply the way that we guys follow. Okay, it has become very common. For example, if you want to buy any asset, okay, so today that asset is of, for example, 10 lakh, 20 lakh, 30 lakh. But instead of paying the entire amount today, you might convert the same into EMIs, equated monthly installment. Okay, and then including the interest amount, you try to pay it in next 2 years, 5 years tenure, or 10 years, 20 years. Okay, whatever the tenure can be. So now the asset is of 10 lakh only, but if you look at the calculation after 5 years, okay, you could see that you have paid 15 lakh. Got it? Now the question arises, the cost of asset is now 15 lakh. The cost that you have incurred to get that asset is 15 lakh. You should record the asset at 10 lakh or 15 lakh. Whether you should record the asset at 10 lakh or 15 lakh.
15 lakhs.
15 lakhs. Okay. The question, the IFRS says that you should always record your asset in the books of account, okay, at the initial amount. Okay, this is known as cash price. This is known as cash price, the price that is of that particular asset without including any other interest factor. Okay, the price that would have been costed, that would have been required to be paid in case if the asset was paid in total today itself. Okay, on spot itself. This is known as cash price. Record asset at cash price. Okay, this is your asset. Record asset. Whereas the amounts that you're paying as an interest will be debited to your P. Okay, will be debited to your PL. As and when you are paying your amount out of the interest, this will be charged to PL. Always record asset at cash price. Always record asset at cash price. Okay, what is deferment means? Deferment means you're simply postponing. You're taking a postpone any payments. Okay, trying to take some extra time so that you could pay the consideration later. Okay, it's like pay later option. Always record the asset at cash price. The difference amount will be recorded as PL, under PL. Okay, there will be a debit and the outflow will be through cash and bank. For example, this is from your bank. So this will be credited from your bank. What will be debited? For 10 lakh, you'll be debiting your asset, and 5 lakh amount will be debited in your PL as an expense. Okay, throughout, I would say, over period. Okay, over period of years for which the contract is there, for the amount that you are paying the interest. Any doubt? Is it clear?
Interest, can you come back again? Over a period of payment or completion of installment?
I would say completion of installment. Okay, completion of installment. Okay, over period of payment contract. For example, the contract is of 5 years. Okay, might be the asset is used for 10 years, 20 years, but the contract that you have taken, that okay, let's take and let's pay EMI for next 5 years, next 2 years. Okay, for that period of time, you will be charging interest to your PL. Is it clear?
You will pay in, you will account on payment basis only.
For the interest amount.
Ah.
Yes, even though it's due, for example, but for that financial year, if it has become due, then you'll charge to your PL account. Okay, and then either you will record it as current liability or you'll record it as a credit from your bank.
Got it.
Okay, I'm not saying that we'll account for this interest on cash basis. Okay, we are still following mercantile. If it's paid, good, it will be deducted from your cash and bank balance. If it's not paid, then it will be shown outstanding liability. Okay, for example, if you have to make a payment on every 31st, so might be you're doing in your accounting, you might calculate and record it in the beginning of the year itself. Okay, as and when it is becoming due. Or for example, it has become due, but you get a 15-day grace period to pay the payments. So might be the payments are made 15 days later. Okay.
Got it.
Good, good. Okay. Now this is another topic, but it will take time. Let me see if we can solve. Give me a minute, please. Okay, do you have BPP kit? Are you planning to buy BPP kit?
Yes, I think it should be bought after June, na? Because there will be some updates. No.
See, there will be very negligible updates, okay? And I'll update you with the changes that happens. Even in the last year, there were like only 1 or 2% changes. Some names were changed. Okay, the chapter topic was changed, or there are 2-3, I would say, additions done of the questions. So there is no much change. So if you have started learning, I won't suggest you to wait for 1 or 2 months and then get books. Okay, the changes are very negligible.
But where do I buy that? From them?
I'll share the link. It's available on Amazon as well. Otherwise, also I'll share the link. The best link I'll share it.
Material, material or PPE kit only?
I would recommend both revision kit, the practice book, as well as study text.
Okay.
Okay, there are 2 books. One tells you all the concepts, and another one has some question practice.
Okay. What is the cost?
It differs from platform to platform. I'll give you the like best available. I'll share the best available.
Yeah, it will be helpful.
Sure. I've seen it on Amazon also. Okay, so I'll again I would say compare and then let you know.
Yeah.
Okay. To start with another topic, I don't think there is enough time. Okay. There is transfer from PPE to investment property and investment property to PPE. So I want to discuss that topic along with example. So let's take it tomorrow.
Okay.
Okay. Till now, any doubt, anything that I want to put in as a feedback?
No, not that as of now.
Okay, it's fine. All thing is fine.
Fine.
Any changes required?
No. No change.
Okay. Thank you so much. Okay, I'll upload this PDF and the video lecture in the app itself. Okay, you can see from that.
Okay.
Okay. Have you got yesterday's PDF? Access to PDF yesterday's?
Yeah, I've downloaded the app. I have to still check.
Okay.
I'll
Okay.
check it let you know.
So everyday sessions PDF will be added to your, I will say, to the app itself in the course itself.
Okay.
Okay. So you can download it from there, and
Okay.
it can be downloaded in your device itself. So you can keep it handy. You can keep it downloaded.
But when will you take Ind AS along with this or separately?
See, here I'm taking up India's along with. So
Okay.
if we are reading, for example, IS 40, so we are including India's 40 also. As I said, the numbering
There
is
is no
started.
carve-outs in both the standards, IAS.
Yes, there is no carve out. Other than that, okay, we are covering the standards simultaneously. If there will be any carve, I will include it simultaneously at the end of the standard.
Okay.
Okay. So we'll cover India's alongside. These are exactly same. The questions if you talk about India's and IFRS are exactly the same. If I talk about DipIFRS, it's exactly same.
Okay.
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 Okay. Thank you so much.
Thank you.
Thank you.